Hello everyone and welcome back to our lecture series on conceptual framework for financial reporting. Today we will explore the first chapter of conceptual framework, that is the objective of general purpose financial reporting. This chapter forms the foundation of why financial statements even exist and for whom they are designed for. Remember, financial statements are just like a health report of a company, showing whether the business is financially fit or is struggling. First of all, let's clear up a common misconception. Financial reports are not just for accountants, auditors, or internal teams. They are designed for external users, specifically the primary users. And these primary users are investors, lenders, and other creditors. Investors are people who buy shares or bonds of the company, and these people want to know whether they should invest or not, whether they should stay invested or withdraw their investments. These people are very much interested in knowing if their investment is safe and growing. Then, lenders are banks or other financial institutions that decide whether to lend money to the business or not. And other creditors are suppliers or vendors who need to assess whether the company can pay its bill on time or not. Now, these users are not just looking at the current year's profit or the existing assets of the company. They are asking deeper questions like, will this profit continue to grow in future? Is the company managing its resources well? Can it survive tough time like a market crash or liquidity crisis? In short, they want to know two main things. Number one, they are looking for the amount, timing, and uncertainty of future net cash flows, like how much cash or money will the company generate, when it will come in, and how risky or uncertain it is. Although financial statements are made on accrual basis, but the framework focuses heavily on cash flows because ultimately businesses run on cash, not just profit. It is the cash that pays salaries, repays loan, and funds expansion. So the primary users want to understand how much cash will come in and go out, when will these cash flows happen, and how risky or uncertain are these cash flows. For example, let's say a company has sold products on credit. The profit might look great on paper, but the cash has not been received yet. What if the customers don't pay? And if not, will the company be able to pay its liabilities? That is why assessing the timing and certainty of cash flow is so critical. And the second important thing the user want to know is the management stewardship of economic resources. That is, how well the management is handling the resources of the company. How effectively is the company's management using the resources to create value. This concept is called management stewardship. For example, let's say you give someone $1,000 to manage on your behalf. At the end of the year, you want to know how much money is left, how this money is spent, and did the other person make smart decisions with your money? That's exactly what financial statements tells you. How the management of the company is taking care of the resources entrusted to them. Remember, if a company made huge profits this year, this does not mean that the company will do the same next year. Maybe some big technological change can happen, or a key management person may resign, or the government may bring significant changes in the laws that could adversely affect the company's business, suddenly those profits might not look so secure anymore. So users don't just rely on past performance, they also consider future prospects and the management ability to adapt and sustain growth. Now, let's talk about what kind of information users actually need from the financial reports. First, users need to know about the economic resources of the entity. Essentially, what the business owns, these are the assets like cash, inventory, property and machinery. But just knowing what the entity owns is not enough. Users also need to understand the claims against these resources. That is, what the business owes to other. And these are the liabilities like loans, payables and other debts. In addition to assets and liabilities, users are also interested in the changes that occur in these resources and claims over time. They want to track how the entity's financial position is improving or deteriorating based on its activities. And it is not just about numbers. Users are very keen to evaluate how effectively and efficiently the management and the governing board are handling the entity's resources. In other words, are the management making smart decisions? Are they using the company's resources wisely to generate profits and grow the business? Are they safeguarding the assets and minimizing the liabilities? This evaluation of management performance and accountability is a big part of why financial report exists. Think of management like the captain of the ship. Financial statements tells us whether they are steering the ship safely or heading straight for an iceberg. So, financial reports don't just provide data, they also give user insight into how well the company is being managed and whether it is on the right track for the future success. Now, let's understand how the financial statement fulfills the information need of the users. There are three key areas covered in financial reporting as shown in this table. First of all, financial position shows the company's assets, liabilities and equity at a specific point in time. It's like a snapshot of the company's financial health. It helps users to assess financial stability, liquidity and solvency, future cash flows prospects and management stewardship. Things like, can the company survive a downturn? Can it pay off its liabilities? Will it keep generating cash? And is management protecting and growing the resources of the company? This is reported in the statement of financial position, also known as the balance sheet. Then, financial performance, that is profitability, shows how much profit the company made during a specific period and whether it's capable of generating income in the future. It focuses on the past performance to predict future cash flows, the company's ability to generate income, and how effectively management is using the resources. This is shown in the statement of profit and loss and other comprehensive income, in short, the income statement. And finally, financial performance, that is cash flows, looks purely at the cash movements, where it came from and where it went. It answers questions like, is the company generating cash inflows? How is it spending its cash on operations, loans or expansions? And is it managing its cash efficiently? This is reported in the statement of cash flows. Investors, lenders and other creditors need to evaluate all these statements to get the full picture. Now, let's take this one step further. Changes in financial position, meaning changes in assets, liabilities, and equity. This can happen for two reasons. Number one, from financial performance. These changes come from the income statement. For example, if a company makes $1 million profit, it increases the equity in the balance sheet through retained earnings. And number two, not from financial performance. These changes have nothing to do with profits. For instance, if the company takes a loan, both assets, that is cash, and liabilities, that is loan payable, increases, but it has no impact on the income statement. Similarly, issuing new shares increases cash and equity, but again, no effect on profitability. So while the income statement explains profitability, the balance sheet also captures other changes that don't show up as profit or losses. Another important concept linked to financial reporting is accrual accounting. The financial statements are prepared on accrual basis. Unlike cash accounting, which records transaction only when cash is received, accrual accounting recognizes income and expenses when they are earned or incurred, regardless of cash movement. For example, if you sell goods today but receive payment next month, the sale is recorded today under the accrual accounting. Similarly, if you incur any expense but pay for it later, it is recognized immediately. This approach gives a better picture of financial performance, especially when transactions span across multiple periods. So to wrap up, the conceptual framework exists to ensure that financial reporting meets the needs of the users. It's not just about numbers, it's about providing useful insight. How much cash is coming in, when it is coming, and how certain it is. Financial statements also help assess management's performance, whether they are being good stewards of the company's resources. And most importantly, financial statements are only part of the puzzle. While they provide valuable insight, investors and decision makers must also consider external factors like changes in technology, laws, or management to make the informed decisions. Remember, trust and transparency are the pillars of financial reporting, and the conceptual framework ensures that trust stays intact. Thank you for watching, and I will see you in the next lecture, where we will dive into the qualitative characteristics of useful financial information. Until then, take care and happy learning.